Welcome to the first episode of our new series about IFRS reporting in the Global Industrial Group. Today, our discussion will be about the new amendments to the IAS 1 with practical application examples from the financial statements of global industrial groups. But before talking about the new updates, let's quickly show a summary revision of the standard itself. The IAS 1 presentation of financial statements. Here you are some important paragraphs of IAS 1 and its use in practice. We will show you examples of financial statements published by largest global building material manufacturers.
Our first example is St. Gobain Group. Its half-year financial report 2022. The condensed half-year consolidated financial statements. Page 4. IAS 1, in paragraph 10. Define a complete set of financial statements that comprises 5 components. The first is a statement of financial position as at the end of the period. IAS 1, paragraph 113. Entities shall cross-reference each item in the statements of financial position and in the statements of profit or loss and other comprehensive income, and in the statements of changes in equity and of cash flows to any related information in the notes. Displaying information about the date of the end of the reporting period. The level of rounding used. Line items that present, for example, the property, plant, and equipment. And so on. IAS 1 paragraphs 60 to 65 about the current/non-current distinction.
The second component of the financial statement is the statement of profit or loss and other comprehensive income for the period. As you see, for example, the consolidated income statement of Heidelberg Cement, as published in its annual report 2021. Also, the consolidated income statement of St. Gobain.
IAS 1 paragraph 82, mention the information to be presented in the profit or loss section or the SOPL. IAS 1 paragraph 99. Discuss the presentation of an analysis of expenses recognized in profit or loss using a classification based on either their nature or their function. IAS 1 paragraph 81. The presentation of profit or loss attributable to non-controlling interests and owners of the parent.
You can read a good article about how to classify expenses by nature and function in profit or loss statement. It is by Sylvia Mahotova in her website CPD Box. In this article, Sylvia answered important questions. How to classify expenses in profit or loss. And what to do when you have to change this classification. Where to present depreciation, salaries, and finally, a good tutorial video.
Back again. IAS 1 paragraph 81. Defines the allocation of profit or loss and other comprehensive income for the period. The comprehensive income for the period that attributable to the non-controlling interests and the owners of the parent. IAS 1 paragraph 90. An entity shall disclose the amount of income tax relating to each item of other comprehensive income, including reclassification adjustments, either in the statement of profit or loss and other comprehensive income or in the notes.
The third component of the financial statements is a statement of changes in equity for the period. Our example is by ArcelorMittal South Africa, a subsidiary of ArcelorMittal Group. Group and company statements of changes in equity for the year ended December 31, 2020.
As you can see, based on IAS 1 para 106. The statement of changes in equity includes the following information. total comprehensive income for the period. Also, for each component of equity, the effects of retrospective application or retrospective restatement recognized in accordance with IAS 8. And as a minimum, to disclosing changes resulting from profit or loss, other comprehensive income, and transactions with owners in their capacity as owners, showing separately contributions by and distributions to owners and changes in ownership interests in subsidiaries that do not result in a loss of control.
The fourth component is a statement of cash flows for the period. This time example by Halsam Group. Integrated Annual Report 2021. The cash flow information provides users of financial statements with a basis to assess the ability of the entity to generate cash and cash equivalents. Also, the needs of the entity to utilize those cash flows. The International Accounting Standard IAS 7 sets out requirements for the presentation and disclosure of cash flow information. We can discuss it in the upcoming episodes.
The fifth component is notes with summary of significant accounting policies and other explanatory information. Now let's quickly discuss two terms are mostly confused by both users and some auditors. The two terms as mentioned in IAS 1 paragraphs 87, 85, 97 and 98 are the extraordinary items and exceptional items. The extraordinary item is abnormal gain or loss that is unusual and is not part of the company's day-to-day business. Under IAS 1 it is prohibited to be reported separately. For example, huge loss caused by natural disasters as earthquakes. On the other hand, exceptional items are material items with a substantial impact on the company's profit or loss, but it is closely related to its day-to-day business. So, will be included in the SOPL line items and disclosed. For example, the litigation charges.
Now, do you agree that both terms could be confused by the auditors and management? Here you are two common cases in the building material industry. The first case. A production line stopped for long period. What about the classification of the depreciation cost that related to the unplanned stoppage? The second case. Unusual flood caused material losses. What about the material losses of damaged stock or assets? Now try to answer this question. What's your opinion? Extraordinary or exceptional? Can you share your insight in the comments?
Now, and before starting our discussion about the new amendments, would you like further resources about IAS 1? You can visit this link. I will put it in the comments to this episode in the LinkedIn. It is IAS 1 presentation of financial statements by Sylvia at her website CPD Box. You can find more than on tutorial video about IAS 1. Also, articles and overview of IAS 1. And very important questions and answers related to IAS 1.
Now, it is time to discuss the new update to the IAS 1. What are the key amends to the requirements for classification of non-current liabilities with covenants? In January 2020, the Board, IASB, issued classification of liabilities as current or non-current, which amended IAS 1. The amendments were effective for annual reporting periods beginning on or after January 1, 2023, with earlier application permitted. In December 2020, in response to a new information, the Board decided to amend IAS 1 with respect to classification, as current or non-current, presentation and disclosures of liabilities for which an entity's right to defer settlement for at least 12 months is subject to the entity complying with conditions after the reporting period. And in November 2021, a corresponding exposure draft was published. Finally, in October 2022, the IASB issued amendments to IAS 1, to clarify how conditions with which an entity must comply within 12 months after the reporting period affect the classification of a liability. The amendments are effective for reporting periods beginning on or after January 1, 2024. So, the key changes are: to modify the requirements introduced by classification of liabilities as current or non-current on how an entity classifies debt and other financial liabilities as current or non-current in particular circumstances. And to defer the effective date of the 2020 amendments to January 1, 2024. But take care that 3 proposals the IASB included in its November 2021 exposure draft were not finalized.
Now it is time to ask the experts. We asked the Chartered Accountant, and the IFRS expert Neela Kumari Jain, to summarize the key amendments to IAS 1 regarding the classification of liabilities as current or non-current. She stated that,
based on amendments to IAS 1 that were announced on January 23, 2020, the amendments in classification of liabilities as current or non-current affect only the presentation of liabilities in the statement of financial position, not the amount or timing of recognition of any asset, liability, income or expenses, or the information that entities disclose about those items. They clarify that the classification of liabilities as current or non-current should be based on rights that are in existence at the end of the reporting period and align the wording in all affected paragraphs to refer to the right to defer settlement by at least 12 months and make explicit that only rights in place at the end of the reporting period should affect the classification of a liability. Clarify that classification is unaffected by expectations about whether an entity will exercise its right to defer settlement of a liability. And make clear that settlement refers to the transfer to the counterparty of cash, equity instruments, other assets, or services.
So, this is what happened in January 2020. But what about the October 2022 amendments? Based on the IASB press release, published on the IFRS.org, IAS 1 requires a company to classify debt as non-current only if the company can avoid settling the debt in the 12 months after the reporting date. However, a company's ability to do so is often subject to complying with covenants. For example, a company might have long-term debt that could become repayable within 12 months if the company fails to comply with covenants in that 12-month period.
But what if company failed to comply with covenants? The amendments to IAS 1 specify that covenants to be complied with after the reporting date do not affect the classification of debt as current or non-current at the reporting date. Instead, the amendments require a company to disclose information about these covenants in the notes to the financial statements. So, as a conclusion, the IASB amends IAS 1 to improve information about long-term debt with covenants. But do there any other update to IAS 1? What are the key amendments to IAS 1 regarding disclosure and the definition of materiality? Let's know the story. On October 2018, the IASB board has issued Definition of Material as amendments to IAS 1 and IAS 8. To clarify the definition of material and to align the definition used in the conceptual framework and standards. The amendments were intended to make the definition of material in IAS 1 easier to understand. For this, the effective date was for annual reporting periods beginning on or after January 1, 2020. Again, on February 12, 2021, the IASB issued amendments to IAS 1 and IFRS Practice Statement 2 that require entities to disclose their material accounting policies rather than their significant accounting policies. This time, the amendments are effective for annual periods beginning on or after January 1, 2023. So, it's material versus significant. Is that all the stories? Let's discuss the changes. Yes, the amendments replace the term significant with immaterial for the disclosure of accounting policies. Also, the IAS 1 amendments added guidance in applying the materiality definition. In other words, when accounting policy information is material. In assessing the materiality of accounting policy information, entities required to consider both the size and the nature of the transactions, other events, or conditions to which the accounting policy information relates. Also, amendments regarding the information about the measurement basis, that in some cases, no need to be disclosed. Finally, and as usual, the amendments emphasize that other disclosures required could be material, even the corresponding accounting policy information being immaterial.
Once again, let's ask the experts. We asked the Chartered Accountant, and the IFRS expert Neela Kumari Jain, to summarize the key amendments to IAS 1 regarding disclosure and the Materiality Practice Statement. She advised that
in making materiality judgments when preparing the financial statements, you may follow the four-step materiality process, as it mentioned in the practice statement to IAS 1. Step 1. Identify information that has the potential to be material. Step 2. To assess whether the information identified in Step 1 is, in fact, material. Step 3. Organize the information within the draft financial statements in a way that communicates the information clearly and concisely to primary users. Step 4. To review the draft financial statements to determine whether all material information has been identified and materiality considered from a wide perspective and an aggregate, based on the complete set of financial statements.
Let's back again to the new update to IAS 1. Still little bit confused? Let's consider the following diagram. Ask yourself, are the transactions, other events, or conditions, to which the accounting policy information relates, material? In size? In nature? Or in both? If no, there is no need to disclose, because the accounting policy information is immaterial. If yes, then you need to consider if the accounting policy information itself material or not. In other words, are relevant to an understanding of the financial statements? Again, if yes, then the accounting policy information is material, so must be disclosed.
Now, let's see a practical example from the published financial statements of multinational industrial groups. The first example is by Cemex Group, 2021 Integrated Report. As you see on page 149 and 150. Notes to the consolidated financial statements. Cemex mentioned both the amendments to IAS 1. Amendments to IAS 1 and IFRS Practice Statement 2, Disclosure of Accounting Policies. Also, amendments to IAS 1, Presentation of Financial Statements, Classification of liabilities as current or non-current.
Another example is by Halsam Group. Integrated Annual Report 2021. Also, in the notes to the consolidated financial statements. Page 184. Also, by St. Gobain Group. In the notes to the consolidated financial statements of the half-year financial report 2022. Note 1: Accounting Principles and Policies. The standards applied. Page 10 and 11. Another example by ArcelorMittal Annual Report 2021. Consolidated Financial Statements, page 251 and 252. Under the notes of Application of New Accounting Standards. And finally, by Heidelberg Cement Annual Report 2021. Consolidated Financial Statements. Notes to the 2021 Consolidated Financial Statements. Page 146 under the notes of Application of New Accounting Standards. You can find the details about the published, but not yet applicable accounting standards.
Would you like another material by professional experts? Here you are, one of the best technical videos by PwC. The video called PwC's IFRS Technical Update Video September 2022. The video shows the viewpoint of professional experts regarding the amendments to IAS 1 classification of liabilities with covenants. Really, it is very helpful discussion that you need to watch. You will find the direct link on the comments to the LinkedIn post of our episode.
Before ending this episode, what's your opinion about the here below questions? By referring to the new update of IAS 1, and as a short comparison, IFRS versus US GAAP. What is the classification basis of debt, current or non-current, under US GAAP? What is materiality according to US GAAP? What are the key differences between US GAAP and IFRS regarding the definition of materiality? How amendments to IAS 1, Material Accounting Policy Information, could impact the ISAs? Let's discuss these all and other questions in the upcoming episodes.
But till this time, I recommend that you can read this featured article by Samantha Hart. It's about debt accounting under ASC 470 and GASB 34. Yes, it's the US GAAP treatment. In her article, Samantha discussed very important points. An introduction to debt accounting. Discussion about the financial statement recognition. The initial measurement and recognition. The short-term versus long-term classification. The subsequent measurement and amortization. Types of debt. And finally, a summary and some related articles.
Also, for the candidates of ACCA and the IFRS diploma. Do you need example questions by the ACCA examiners? With advice and keynotes? I'll try to share advice and insights by professional tutors in the upcoming episodes.
In the upcoming episodes, I will try to discuss the amendments to the IAS with examples. See you.